every December for the past 14 years, Barron selects 10 stocks that they believe will outperform the S&P 500 over the next 12 months. In 2023, some of their picks included Delta Airlines and Comcast, and on average they returned 31%, including those dividends reinvested, outperforming the S&P, which is up around 24.5% year to date. So what we're looking at now is for 2024, what are they picking and exactly whether or not these are companies we should be excited about and we should be looking to add. So we have the full list here if you do want to take a look, but in today's episode in particular, we will be looking and analysing Chevron Corporation to see whether or not it is a buy for 2024 and whether or not it is undervalued. We can see though, year to date, it is down around 14%. Now, what we're going to do in today's episode, as usual, we will run it through our valuation model, getting to our intrinsic value and what we believe to be our acceptable buy price for Chevron, including our investor margin of safety. We're also going to run through some of the details, the income statement, looking towards their December 2023 annual report, how the company has progressed their top line revenue as well as their bottom line net income. We'll analyze the strength of the company's balance sheet, their total cash versus total debt. We'll compare them to the industry, the oil and gas, how they've fared versus their competitors over the last few years. And as always, we will analyze their dividend safety, looking at some financial metrics to see whether or not this is a strong company for the longer term. And as usual, we will take a quick sneak at the institutions. Are they buying or are they selling this company? So Chevron Corporation, a huge oil and gas player, down 14% year to date, pretty much trading towards the 52-week lows. And over the last 10 years, if you've been holding this oil giant, you would only be up 21%. Now, it doesn't include those dividends reinvested, but that's not the greatest return over the last 10 years. And we see the all-time high towards the back end of 2022 at around $186. So let's take a quick look, and for those that don't know, it does offer a yield just over 4%. Now, in terms of their income statements, one thing to bear in mind, whilst we do like to see 3 to 7% growth on the top line year on year, it is a very cyclical company in a cyclical industry. December 2018, 151 billion reported on the top line. December 2022, 236 billion. So they have increased their top line quite considerably over the last 5 years. But a few things to point out. Their top line did decrease from 2018 down to 2020, where we did see the very low share prices of these oil and gas companies. It then has picked up all the way to 2022, but as we can see, to a trailing 12 months for 2023 is showing a dip from the last year share or the last year revenue. So something just to consider, it is essentially a cyclical industry. Now, in terms of the net income, 14.8 billion reported in 2018, 35 billion in 2022. So like the top line, the bottom line has also progressed quite strongly as well. In fact, more than doubled. And we do see again the cyclicality showing decrease from 2018 down to 2020 before picking up nicely to 22, with 2023 expected to drop again. So as you can see here, very cyclical, both top line and bottom line. And as always, do hit that like button, do smash the subscribe button if you do want to know when the December 23 report comes out, and we will analyze this on the channel. Now, balance sheet, a quick total cash versus total debt. December 2018, 10.3 billion of cash and short-term investments. Latest quarterly report, they are holding nearly half as much as they did 5 years ago at just under 6 billion. Now, when we compare that numerically and directionally to their total debt, what we can see here, it has gone from 34.5 billion down to 20.5 billion. So that's a very positive sign, because if we see the cash has dropped, but the total debt has dropped even more than the rate of the cash, so that's very positive. They are paying off their total debt over the last 5 years. Now, comparing very quickly to those in the oil and gas, we have Shell, we have Total Energies, ExxonMobil, BP, quite some well-known companies in the industry. Now, year-to-date total return, so it includes those dividends reinvested, we can see that Chevron is down around 11%, the worst performer of the industry. We see Shell, in fact, the best performer, up 20%. So if we go from year-to-date to the last 5 years, Chevron is in the middle of its peers, up around 70%. Shell, which was the best performer year to date, is actually one of the worst performing. And we can see ExxonMobil as well as EQNR the top performing in the industry. So It hasn't performed that bad over the last 5 years, but as always, past performance is never an indicator for future performance. Now, institutional ownership sits at around 69%. We see around 22.94 billion worth of outflows by the institutions over the last 12 months. And during the same period, we see a significant amount more of inflows, around 96.7 billion, with the largest inflow coming in Q2 of 71 billion. Now, the latest quarter, we do see, in fact, around the same amount of inflows as we do see outflows. And as we always mention, it is quite important to understand you should never base your trades off what the institutions do, and always do your own due diligence. Now, in terms of dividend safety, it comes a score of 90, very safe. For those that are interested, ExxonMobil's score is 80, so it has a safer dividend than XOM. Market cap, 282 billion. It is a mega cap company. And when we take a look at some recessionary metrics, they have in fact increased the dividend during the 07-09 recession. Negative 43% sales, so significantly less than the S&P average. And we do see here recession return, they actually outperform the S&P with a negative 34% return versus the S&P's negative 55%. Now, dividend growth, this is quite nice in my opinion. You are getting above inflation increases. As I always advocate on the channel, you want to be aiming for a minimum of 4% increases, whether it's your salary, dividends, or other income producing assets. Otherwise, you are losing your purchasing power and taking a pay cut. So nice to see 6% over the last 5 years, and even nicer to see 7% on average over the last 20 years, while also taking a very nice starting yield of around 4.04%, which will look more attractive in the upcoming years as the interest rates do start to cut. Two things to note here. They are a dividend aristocrat. They have paid increasing dividends over the last 25 years or more. And another thing to note is they have paid dividends for the last 111 years without a reduction. So that is very positive. It is what you like to see from those companies you are looking to invest in. Now, dividend yield theory, for those that are new, states that the company is undervalued when the current yield sits below, or in fact, when the current yield sits above the 5-year average. What we have here is roughly reasonable valuation. It is pretty much in line with the 5-year average. And forward PE, we see it slightly lower at 10.5 than the 5-year average. So on the forward PE basis, there is a sign of undervaluation. And when we compare it to the sector PE and the energy, it's around 11.5 versus Chevron's 10.5. Now, just because it is towards the 52-week low, do bear in mind that isn't an undervaluation signal. Likewise, a 52-week high for a company isn't an overvaluation signal. Earnings susceptible to manipulation by management through accounting, I tend to ignore it and focus on the free cash flow. Below 60% is my personal preference. You could drop this down to 40% for oil producers. For me, 60% gives me faith that management, if possible, are able to offer double-digit increases. Now, last 2 years, we do see it below 60%. In fact, 2023 as well is expected to be lower than 60%, but higher than the previous year, with 2024 expected to be around 41%. Now, this is just something to note around the cyclicality of the company. We'll mention that word quite a lot when we look at these metrics, and you'll understand as we go through them. Free cash flow per share, well, we see here 2013 to 2016, negative free cash flow. It did then pick up, but it still was in consistent growth with a drop in that COVID year down to 89 cents, before picking back up with 2023 expected to drop lower. Now, when we look at the sales growth, this is probably the perfect picture for the cyclicality in the industry that we're relating it to. 2013 to 2016, just pure negative growth on the top line, followed by double-digit increases back-to-back, and then double-digit, or in fact a year of double-digit decrease and a single-digit, and we can see the trend going on and on. So this is something you should come to expect when investing in cyclical industries. This is shown very clearly with the total sales. Now, shares outstanding, they do share buybacks. They've also done share issuances, diluting your position as a shareholder. Over the last 10 years, realistically, they've only really increased it by around 100 million. I would like to see them start to do some share buybacks, returning excess cash to investor pockets. ROIC, personally, around 10% or more, gives me faith that management are able to effectively allocate their capital. The last 2 years have been very inconsistent. To be fair, so have the preceding 8 years. 2023 at 15% is very strong in my opinion, above that 10% minimum I look for, but something just to keep an eye on, especially the other metrics that we have run through too. And again, operating margin as well as the free cash flow margin, very inconsistent here as we can see, although do note 2023 and 2022 does expect to be much better than the previous years. So it is looking fairly strong for the company, with the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, showing us two things. Firstly, the strength of the balance sheet, and secondly, the dividend safety. These are the number of years it would take the company to pay off all of their debt net of cash on hand. 2022, 0.17, very, very low. 2023 expected 0.31, slightly higher but still extremely low, giving us a sense of security in not only the dividend but the balance sheet and the operations of the company so far. So what about the valuation? Let's jump in, and as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And finally, do click on that pinned comment below if you want to grab a copy of the intrinsic value calculator to get to the intrinsic value and acceptable buy price of companies in your own portfolio. Jumping to the first model, Graham's valuation, we have the stock ticker, the earnings per share, growth rate per analyst estimates, and that yield on AAA corporate bonds, giving an intrinsic value of $167. Now, when we take a look at that, that is some nice upside to the current trading price at around 10%, but still below that 52-week high, showing signs of undervaluation in the current market. We then move on to the multiples valuation model, those companies we analyze. We have their PE multiple, average PE multiplied by the earnings per share of CVX, to give a stock price of 117. Now, when we take a look at that, it is significantly lower than the current trading price and lower than the 52-week low, showing signs of overvaluation. One argument for this is, as you can see, a lot of these companies that we have taken do have a very low PE multiple, so it could be worth on the next episodes to take a look at BP and Shell to see whether these are significantly undervalued. Now, when we take a look at the DDM, dividend discount model, average growth of 6.17%. Forward looking, we've estimated 5%. As always, if you grab a copy of the model, you can play around on these numbers based on what your investment thesis is. 211, so that is showing signs of undervaluation now, severe undervaluation and above that 52-week high. Remember, it is important we're not looking at any of these models in isolation, and we'll draw conclusions towards the end. We then have the DCF model with the free cash flows year on year. Average growth rate 134%, that is very, very high. Forward looking though, interestingly, analysts are expecting a decrease in the free cash flow. In conjunction with our discount rate, we get the present value of these future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. We get a DCF price of 214, and as you can see, very similar to the DDM model, some severe signs of undervaluation to the current market. Now, the intrinsic value is purely the average of these four models that we have gone through in today's episode of CVX, and we can see the intrinsic value coming to 177. Now, current price at just under $150, we always start off with a 10% margin of safety if we believe it has a wide moat, strong financial metrics, and good forward-looking data. So if you believe that, it would be a buy up to $160. At 15%, it is pretty much at the current trading price. So based on our estimates and judgments, we do believe CVX has around a 15% margin of safety. Now, in terms of Wall Street and what they believe, well, they see the price over the next 12 months to go up around to $180, as you can see here. So they do believe that the current price has around 20% upside. So in conclusion, essentially CVX, based on our estimates, has a 15% margin of safety, with Wall Street expecting 20% upside over the next 12 months. As always, let me know your thoughts in the comments below. Do you believe it is time to start buying these oil giants, Chevron, Exxon, and the others, or do you still believe there is some way to go? Now, me personally, it does really depend on what you believe your margin of safety to be. I would be happy to start adding these companies with a 20% margin of safety, which is around $142, as we can see pretty much at the 52-week low. Now, it will be interesting, though, to note, I know a lot of people on this channel have essentially been buying when it was that COVID dip, and a lot of you are probably still holding on with some very high yields on costs. So I'd like to know whether or not you are looking to continually add, or maybe you are looking to sell. As always, if you've enjoyed the content, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And don't forget to click on that pinned comment below so you can grab a copy of the intrinsic value calculator to get to the acceptable buy price of companies in your own portfolio or on your watch list. As always, have a great day and catch you all on the next episode.